And to kick off our programming this hour, we're joined in studio by one of our regular guests, Philip Petursson, Chief Investment Strategist, IG Wealth Management. Nice to see you.
Good to be here.
Okay, first voice of the day, no pressure, Philip. Yeah. What do you think the Bank of Canada does?
Well, I think they're going to cut. The futures market is suggesting they're cut. Can we agree they're going to cut? I think that's it seems to be the foregone conclusion today that, okay, enough's enough. Inflation's in the target zone. GDP growth, as you mentioned, is below where it should be. It's below the Bank of Canada's targets. Everything sets up an environment to justify a cut by the Bank of Canada.
Most economists surveyed by Bloomberg are expecting that we would see a move lower by 25 basis points. I mean, that's not going to make a dramatic change for the average Canadian navigating the mortgage market. It could for a big city mortgage holder. Let's say you got a variable rate mortgage. Maybe that ends up saving you upwards of $1,000 a year, maybe a little bit more. But it is a starting point. But I guess the flip side to it, why are we still, even though there seems to be some consensus that we're going in this direction, not quite sure that the Bank of Canada is going to pull the trigger today?
In my view, it's because they haven't made a clear argument that cuts are coming. And I think the hesitation revolves around the fact that the Bank of Canada, even though they say they're independent, I do think they're paying attention to what goes on south of the border. And the further and further cuts seem to be from the Fed, I think that puts pressure on the Bank of Canada to say, okay, if we cut and we cut aggressively, that's going to punish the Canadian dollar, and that's not the desired outcome.
So there's a couple of points to chew on. Let's just talk about the dynamics between Canada and the United States, because coming into what is likely a pivot point here for the Bank of Canada, our rates theoretically are lower than where the American rates are. So if they move before the U.S. Fed, that would increase the gap, if you will, between the borrowing costs in both countries. Why does it matter if Canada's going ahead of the Fed outside of that currency story, or I guess as part of that currency story, too?
Well, really, I think that's it. I think it is all about the currency, because if the further the Canadian dollar falls, that is inflationary. A lot of our imports come in from the United States priced in U.S. dollars. And so if we see the Canadian dollar weaken by 5%, say to 70 cents, then you're getting that unintended increase in inflation.
Because we buy a lot of stuff from the U.S.
Exactly.
And our currency is weaker. How are Canadians, in your opinion, handling borrowing costs? That's the other part where I think people debate, right? Like the sticker shock of higher mortgage rates, or even what you're paying for your credit card, or what have you. Those who have argued against the Bank of Canada being right at the point where they actually do need to cut rates have said, not all Canadians are navigating the mortgage market right now, and there have been some signs of resilient spending. They still have some time on the table. But as you assess it, how challenging an environment is this for Canadian borrowers?
Well, I think that's taking a glass half full approach, because when you look at the economic data over the last year, it's been weaker. Look at the revision to the fourth quarter GDP for Canada, down to 0.1%. We're bordering on that recessionary environment. Now, Q1 came in decent at 1.7, but let's wait for the revision there as well. So I would argue that the Canadian consumer has faced the burden, but it's just going to get worse. When we model out the change in the 5-year rate from the expiring rate, we're hitting upon the next 6 months an increase in that delta, or the change in price for your mortgage, or the cost for your mortgage is going to be greater in the next 6 months than we've seen over the last year.
Just out of curiosity, how do you feel the population growth story in this country has complicated the math on all these people who get paid lots of money to try to figure out what's happening with their economy? Has it masked a little bit what the real consumption story is, or even what the real inflation story is?
I don't know if it's masked the real inflation story, but I think it certainly has masked the consumption story. It's probably made the consumption story a little bit better than it otherwise would be, which is already weak.
Okay.
So, there's not a lot to like in the Canadian economy right now.
Well, that is one of the reasons why you have been cautious on the Canadian stock market. Is that fair?
In part. There's segments of the Canadian stock market that are levered to the Canadian economy, and those are the ones that we think are going to continue to come under pressure.
So let's try to do a little bit of road mapping here. You think the Bank of Canada is going to cut rates today, and then what do you think the roadmap looks like? Are they going to give a clear outline, in your opinion, on what they're going to do for the rest of the year?
I think they will. I certainly hope that's going to be the case. And so what we have laid out is a cut in June, so a cut today, a cut in July, and then a pause, and then perhaps another cut before the end of the year, so in the fall. That would be 3 cuts for the Bank of Canada. In contrast, we only have the Fed cutting once.
And then you talked about the dollar dynamics and that being maybe a tricky part of this whole story. Would you anticipate that the Canadian dollar, which has sort of been bouncing around 73 cents, I feel like, for the longest time here, what do you think would happen with our loonie if we start moving into this new pivot point for the Bank of Canada?
Right. So first, the way we measure it, the loonie has been entirely correlated with the difference in interest rates between Canada and the United States. When we attach a fair value to that based on rates, guess what? We get to 73 cents or just slightly below. So there isn't a lot of deviation there. But and so the market right now is pricing in that the Bank of Canada will cut once more than the Fed. So we're seeing a 75 basis point difference in that two-year rate. If we're right, though, and the Bank of Canada cuts 3 times and the Fed only once, well, that'll be 100 basis points difference, and that could push the Canadian dollar down to 70 cents, maybe upper 69 cents.